Hello again, this is Dale Becker with RE/MAX Masters. Thought I would take a few minutes this morning and just clear a few items off my desk, share some information with you that might be relevant as you make decisions about what to do in this housing market. Let me first start with the fact that interest rates today are still in the low fives. I find that rather remarkable myself, and I found a great piece of visual evidence here that will show you clearly why so many people are concerned about inflation over the next couple of years. This is actually a chart from the St. Louis Federal Reserve showing the monetary supply, and if you look back here, this is basically where the Great Recession of 2008 started. Monetary supply has since more than doubled. Over $2 trillion in circulation today, thanks to the Fed's bailouts and easy money policy. And the reality is, when you look at this chart, there's legitimate reason to be very concerned about inflation. And what does that mean for the real estate market? What does that mean for people considering buying a home? In simple English, it means that if you can get a 30-year fixed rate loan in the low fives today with a reasonable expectation that rates are going to be in the sixes or maybe even in the sevens within 2 to 3 years, that makes today's money awfully cheap and a really great opportunity to lock in a low payment for a long, long time. One other thing that's more of a technical point, but something we'll certainly discuss face-to-face when we meet, and that is the fact that most FHA loan products are in fact assumable. And that means that if you get a 30-year fixed rate FHA loan today at 5.25 or 5 3/8 or whatever the prevailing rate is, you may have the opportunity to use that really, really low interest rate loan as a strong selling point when you resell that home 3 or 4 or 5 years down the road and rates are significantly higher. So interest rates on everybody's mind, on my mind, and again, the $1.25 trillion Fed buyback program expires at the end of March. This has been one of the primary reasons rates have been so low, and we're all just waiting for the other shoe to drop here in the form of higher rates. Other thing I wanted to talk to you a little bit about this morning is the condominium market, and specifically FHA financing and how it's going to impact the condominium market going forward. There's a lot, in my opinion, to be concerned about in the condo market. And there's a whole seminar behind this. I'm trying to keep this short and to the point this morning. But one thing that's really relevant to consider is there are big differences between buying a single-family home and buying a condominium. The average period of time, according to the National Association of Realtors, that a single-family home buyer will live in that property is somewhere around 7 or 8 years. Condominium ownership, by contrast, tends to be much more short-term oriented. The average time is about 4.5 years that somebody lives in a condo before they move on. Condos normally have buyers making smaller down payments, more entry-level buyers, more financially vulnerable, susceptible buyers to the downturn in the economy. And what you've seen when you add all of this up is just an awful lot of distress in the condo market. So, with that as a background, FHA, which is a primary driver of financing in the condo market, has decided that they've lost enough money on condos. And their solution is to tighten things up significantly with the willingness of FHA to loan into condominium developments going forward. Let me share with you some of the changes that are coming with FHA requirements in condominiums. FHA is proposing that they will no longer insure mortgages in developments where they hold more than 30% of the loans currently. This is huge because so many developments have 50, 60, 65% FHA loans. If you cut off FHA financing, you're losing a very large portion of the buyer pool, and that's going to affect prices. There's no way around that. FHA says that they will no longer lend in units where owner occupants are less than 50% of the occupancy. And again, with the downturn in values over the past couple of years, you've got condo projects where a lot of the units are rentals. And owners are either waiting for the market to come back or the developer pulled unsold inventory off the market to rent. But again, if you own one of these units and you expect a buyer to come along with FHA financing, it's going to be a lot tougher to make that happen based on some of these restrictions. FHA says that it will no longer lend in developments where 15% or more of the owners are delinquent on their HOA payments. This is another big one because, as you can imagine, there are plenty of developments around town where you've got people who have stopped making their HOA payments, trying to make their mortgage payments. And again, if FHA won't finance, it makes things harder on everybody. FHA says it will no longer lend in units where a single investor owns 10% or more of the units. They don't want too many eggs in one basket. And FHA is also going to be taking a harder look at the reserves in HOA's care. You see a lot of HOAs today with very little money socked away that are running on bone dry budgets. And again, the sum total of all of this, it is going to be more difficult to finance condos. If you own a condo now, you need to be thinking about this and whether you want to ride this out. If you're looking to buy a condo now, I hope your agent's telling you this stuff because it is really, really important that you know before you buy in a condo project today. This is Dale Becker with RE/MAX Masters. Feel free to call me anytime, 303-416-0087, or visit me online, www.dalebecker.com. Thanks, and have a great day.